Hey guys, how's it going? That was a dance party, I feel like. Um, Glenn, thank you for doing the music. Hey Mark, how are you?
I'm very well. Thank you for asking. How are you doing?
I'm well, thanks. Okay, so this DAO discussion really kind of stemmed from, we're talking about, and we introduced carbon as a new AMM design, and as we continue talking about it and doing more comparisons to limit orders and order book systems and things of that sort, some community members have been really kind of trying to distinguish what carbon actually is. Is it a new AMM design? Is it just an on-chain trading protocol? Is it an order book system? What exactly is it? And I don't know if there's an exact answer to that. So I thought maybe we could just get up here and discuss it. And for anybody who's listening who wants to join the conversation and ask any of their own questions or add any of their own input, by all means, please do. But Mark, I guess I kind of want to. We were on a Twitter Spaces the other day, and you said you're not even sure if you personally consider carbon an AMM. And we didn't elaborate on it then. I'm hoping we can elaborate on that a little bit now.
Sure. Okay. Well, to to my mind, an AMM is a protocol that manages a like two or more reserves of different cryptocurrencies in such a way that the reserve ratios match some value ratio. And so what I mean by that is that, for example, in a constant product AMM, at any one time, if we trust the marginal price on its curve, then 50% of the total value of its liquidity pool will be denominated in one asset, and 50% will be denominated in the other asset. Obviously, Bancor version 1 started off with a slightly more diverse repertoire of different, of different weights. So you can have, for example, a 20-80 ratio or a 30-70 ratio. And this thing was popularized by Balancer, which is another type of AMM design, which can have, even multiple tokens. So you can have like, three different token reserves with, equal weights, so 33% apiece. Or you can have one of those tokens have 50% and the other two have 25% apiece, or whatever. There's many different ways to do it. But to me, the defining aspect of an AMM is something that does maintain these reserve ratios strictly. And carbon certainly doesn't do that. And so, yeah, to my mind, we've kind of shaved off a lot of the AMM like properties in the design of this thing. So I'm not. I don't really consider carbon to be an AMM anymore.
Somebody asked if, you know, I would consider, and I don't personally see it this way, and I'm looking for your input on it also. If if we would consider, you consider, I guess I should just ask you directly, do you consider each order its own AMM? This was something that was brought up by a community member also. This is the way that they see it, and I'm not quite sure I see it that way. And we kind of went back and forth a little bit. And I know that, I mean, it doesn't have two or more reserves, like you were just saying. In what way could it be viewed as its own AMM then?
Well, yeah. So this is my this is the definition of AMMs that I use, right? And the reason I use that definition is because I think at some stage you need to ask yourself, what does it mean to be an automatic market maker, right? And at some most basis level, it is something that guarantees liquidity, right, for against a particular pair or a basket of assets, no matter what happens to the price. Even if that liquidity can get pretty thin, it still guarantees liquidity. With carbon orders, it doesn't do that because if an order is, if you can run an the token balance on an order to zero, then it no longer has that property of guaranteeing liquidity at any price point. So no, I think though that when people are talking about each order on Carbon being its own discrete liquidity pool or its own discrete AMM, what they may be referring to is just the that that each one features a token balance, and if we're talking about linked orders, then 2 token balances, and 1 or 2 liquidity, 1 or 2 bonding curves that describe how trades can be processed against them. So if you consider a bonding curve to be something that is exclusive to AMMs, then sure, each order on Carbon is its own AMM. But I just don't think the utilization of a bonding curve and the ability to process trades trustlessly and in a decentralized manner is sufficient to award something the title of AMM. So I don't think that the orders on Carbon are discrete AMMs. I do, I do recognize that they each have their own bonding curve, and if that is, to you personally enough to satisfy your definition of an AMM, then so be it. But I think that is a little bit, being a little bit liberal with the term.
Right. Okay. So in what way would you consider it an AMM? Like we're having these Twitter spaces and stuff, and we're talking about AMMs evolving and the industry just evolving in general, right? So some see it as kind of an evolution of an AMM.
Sure.
What?
Yeah, I think.
Go ahead.
So, I mean, if we kind of have a look at the timeline and the the narrative that brought that preceded the development of Carbon, or the design inspiration for Carbon. If you consider something like a constant product AMM to be the starting point, then with Bancor V2 and then later with Uniswap V3, we were already starting to dispose of some of the properties that make AMMs in my view, right? So when we moved into the concentrated liquidity paradigm, even though both of these protocol designs use like a token abstraction, right? So they actually do pretend or virtualize token balances such that it actually does behave like a regular constant product AMM. In reality, it's not, because the token balance can still run out. So I think, and even because Bancor V2 in particular didn't really have innate price discovery, right? It was using a price oracle to deliver prices to it. Was probably a lot less like an AMM than Uniswap V3 is. But even then, Uniswap V3, these virtual token balances that are maintained at a certain ratio doesn't really mean anything, because the real token balances can run to 0. So that's the concentrated liquidity part. So I'd say that that's one step away from the original AMM concept. And then what we're doing now, which is asymmetric liquidity, we're continuing to sort of shave off these, these primordial properties of AMMs. And so with the asymmetric one, not only are we concentrating liquidity, but we're also making certain that once a trade is processed in one direction, that it can't process the trade back the other direction. So it's now so far removed from the original the original behavior of an AMM that I can't actually find anything in common anymore between what Carbon does and what AMMs originally set out to do. And there's good reason for that. And this kind of comes back to your question about, people say that these things are evolving. They certainly are. When all of this started and we were trying to figure out how to create liquidity between tokens and support decentralized exchange, it really didn't have much financial motivation behind it, or at least not in the way that we think about financially motivated decisions today. It was really about supporting cryptocurrency, right, and making sure that these tokens could live and breathe on their own and have an exchange profile with other tokens. So it was really about a supporting infrastructure for cryptocurrency economies. it wasn't its own financial instrument. And I think that we've more and more sort of drifted away from those early ideals towards something that is a much closer analog to traditional finance, and that AMMs and decentralized exchanges should behave and offer its users roughly the same sort of experience and utility that conventional exchanges offer. And so in that sense, I'd say that things are becoming a lot more order book like over time. And to that end, I think Carbon really is just an order book. Like that, I would describe it as an order book first and not an AMM. Having said that, it does obviously maintain some of its AMM history, right? So we still describe the way that it processes trades with bonding curves, and we support range orders as opposed to discrete limit orders, which also use bonding curves. So it still is it's holding on to those kind of evolutionary vestiges of its former AMM self. But to my mind, it's much closer to an order book, and that evolution of AMMs in that direction, I think, is reflective of the fact that everything that's happening in cryptocurrency, it started off with much more humble beginnings and is now being compared to or being asked to replicate the traditional financial world. So it kind of makes sense that that those original designs have kind of been outgrown and replaced by analogs of what you see in traditional finance.
Sorry, I was trying to unmute myself. Thank you. Rick, he jumped up on stage while you were in the middle of talking, so I feel like he has something he wants to say to this. Rick, are you able to unmute?
Yeah, I think we got it worked out. Can you hear me okay?
No, not yet. Glenn, I think you're unmuting at the moment.
No, he's good. I can hear Rick.
Rick,
yeah, I can hear Rick as well.
Yeah, he's good.
Okay, just me.
Yeah.
I'll figure that out then. Go ahead, Rick.
Okay. So my question, I guess with this being a DAO discussion, I'm curious if the reason this question has come up is more in line with not so much exactly understanding what Carbon is and defining it, so much as how is it going to interact, compete, or live with V3 as we move forward. And I think that's probably where when I look at just the basic definition of, when you look up online, what is an AMM or whatever the case may be, the most basic definition states that it's a system that facilitates automated trading on a decentralized exchange through crypto liquidity pools funded by liquidity providers. And although I think Carbon definitely has some of those features, I think that's a very limiting definition. But I think for the DAO's perspective, it just needs to be clearly known that it's not going to compete with Bancor V3. It actually will even benefit it, as it even does some of the swaps through that exchange or arbitrage or even from other pools that are out there. I think that might be the overarching question that people have and are looking to get clarity on, if that makes sense.
Yeah, sure. I mean, I agree with that. It's the two are not the two products have very little in common, and so they aren't competing with each other.
Okay, I missed what Rick was saying, so I apologize. I had him muted on my end for whatever reason. But I guess then, if they're kind of like, we see AMMs kind of shifting, because I see them shifting, right? We've been talking about this, like I said earlier, on the Twitter spaces and stuff. Do we see this is what the industry wants, this is what the market wants, so this is kind of where we're headed? Like, AMMs still have a place in crypto. They won't just go away.
Yeah, Mark. So I think we can maybe I'll reiterate what Rick just said, and then I can because I think that it plays well into what you just asked. So what Rick was trying to point out is that maybe the reason why this DAO discussion is important is because it may speak to whether or not Carbon is directly competing with things like Bancor V3. And I would say decisively no. They have so little in common that it would be difficult to offer any compelling argument as to why one would be absorbing or cannibalizing the other, right? Because they have completely different use cases. They appeal to completely different demographics, and they do different things. With respect to what you were saying there, Jen, which is that will there always be a place for AMMs? I certainly hope so. Remember when I said that these things had humble beginnings? It really is to support cryptocurrency, right? To make sure that these things always have de facto liquidity somewhere, and that you can learn the price of a token through the market's interaction with that AMM. But I do think that since the space has changed so rapidly towards being something that is a refined and efficient financially motivated machine, it's unclear how that early AMM design should be employed, right? Because we know even from recent analysis of concentrated liquidity protocols that the cost or the risk of interacting with them as a liquidity provider is pretty high. And while concentrated liquidity generally offers significant advantages to traders, right? To takers, people who want to trade against that liquidity but not provide it, is very good. And I think that is certainly something that we don't want to forget when we're critical of concentrated liquidity or AMMs generally. The people that do provide liquidity to these protocols are, taking a significant risk. And, I did, it's without exaggeration that I say that I have staked my reputation in trying to figure out a way to make that original AMM design something that has a stabilizing feature at its core that really does facilitate this kind of utopian view of how AMMs can persist and how we can create liquidity against an arbitrary number of tokens in a system that is welcoming and supportive of token projects. And this was I would say that the market has now spoken, and it's not really interested in those kinds of altruistic ambitions, and is much more self-interested, which is fine. It's in a way it's kind of a shame, but it might also be more mature, right? It might just mean that this is that next phase of crypto where as it is becoming more legitimate, that we expect to see a lot less of that kind of altruism, in the market generally, and a lot more of this kind of cutthroat attitude as to how we treat, liquidity and trading and exchange. So I think for the long tail, we should expect to see AMMs persist probably forever. I think that they have been enormously successful in that regard. And I think that we will always see new projects that are, ambitious to create and bootstrap liquidity for their projects, wanting to offer liquidity mining rewards and other incentive programs to try and maintain that de facto liquidity. And it's not necessarily my position that I think that an order book-like protocol or even a concentrated liquidity protocol will ever be able to service those communities the way that standard constant product and other similar AMM designs have. But that doesn't mean that they're guaranteed to live, right? Just because that they are providing a significant utility and that they have been sort of the lifeblood of new projects, and we've seen an enormous amount of value in supporting new projects come from that technology, that may not be enough to expect that they will live forever, but I hope that they do.
And what about IL specifically? There's no impermanent loss on carbon, right? And we had kind of spoken about this, and I want to build on it a little bit. It's always been known to be like a direct consequence of an AMM. Does this just kind of go back to your own definition of it and why you don't really classify or categorize carbon as an AMM?
Yeah, it does. So, I think that the distinction there is that IL, it is different, both, I think, conceptually and practically from profits and losses. So, when someone decides to, to sell a token, and maybe they sold, Bitcoin at $45,000 during the last bull run, only to see it go up to $60,000. We don't really treat that as impermanent loss. Like if they bought Bitcoin at $3,000 at the bottom and then sold it at 45, we would just recognize that as being a profitable trade. And the fact that the market tended to trend a little higher after that is just no one can call the top and so on. Which is interesting because in an AMM context, you could actually make the argument that IL is that same type of opportunity cost that you suffer from selling your tokens lower than you could have if you just hodled and sold them all later, right? Because the AMM constantly sells your tokens all the way up. And so you only end up with the square root of the price that you could have sold it at. And I do see that as a direct consequence of what the AMM does. And so in view of that, I would describe IL as, the reason why IL stings so bad is because it feels like it's something that was done to you rather than something that was the result of your own volition. Whereas profits and losses doesn't sting so much because you sort of made that decision, right, to buy something at a certain price and sell it at another price. And I think that this is generally true, right? When people, there have been experiments in psychology where, the severity, that someone feels hard, where someone feels that they've suffered as a result of some outcome, when they feel that they were personally responsible for that outcome, they accept it. Whereas when it feels like it was something that was outside of their control and the result of some external factor or tormentor, then, they refuse to accept it, and it feels more unjust, and it feels, more like they've been victimized by something. And I think that that's the difference here. In an AMM, because the AMM is automatic, right? It's making decisions for you. That's when the IL discussion becomes relevant, because what you've really done is you've asked the AMM to utilize a very specific trading strategy on your behalf. And when it underperforms or when it performs badly compared to HODL, you feel like, the AMM failed you, not that you made a bad decision by contributing your funds to an AMM. Whereas on an order book system, if you choose the price to buy and sell at, and it just executes it at those positions, and you could have maybe bought it slightly cheaper or maybe sold it at a slightly higher price, that comes down to your ability to predict how the markets move. And so people will generally sort of accept that kind of, shortcoming, because, they did make that decision. They were the active agent in how those tokens were bought and sold. Whereas being absent from the decision making of an AMM, I think, is why IL is a concept at all, and why we didn't have a word for it, or it wasn't really something that entered the financial lexicon until AMMs were invented. So yeah, I do make this distinction. I think that it's an important distinction to be made, and I do think that IL is something that's a consequence of the AMM making decisions for you, and therefore, if you're making the decisions at every part of it, then IL is no longer a relevant concept. I should point out here, by the way, that automation that you get out of an AMM is the thing, right? Is the causative element of IL, and this further, I think, bolsters my argument that carbon is not an AMM because there's nothing automatic about it. And we talk about things like rotating liquidity, so maybe that was a bit extreme. There are automatic components, but really it's a manual market maker, right? It doesn't take liberty to make price calls the same way that traditional AMMs do, and so in that sense, it's not an AMM either, and therefore is also the IL argument doesn't apply.
Okay, so when you're speaking about profits and losses, that speaks more to an order book. And when you're referring to IL, that's more to an AMM. And
I mean, you
as
can
far
think
as
of
like,
it that way.
okay.
Maybe I should clarify. IL, I think, speaks more to the fact that the protocol has done something on your behalf. And if it didn't do that, your valuation would be greater. Whereas profits and losses is all about the user's decisions. And so user decisions are certainly more order book oriented, but there are so many other things that you can do that aren't order book oriented. But I do think that it is that the distinction is whether or not the protocol made a decision or the user did. And that's what distinguishes whether or not we're talking about IL or profits and losses, rather than, I think that that's a more helpful dichotomy than AMM or order book.
Right. Okay. And when we're speaking to the automation of it with an AMM, it's doing it on your behalf without your say. And with an order book, or well, with carbon specifically, the automation comes in. It's automatic. The trading strategies that we're speaking about and the rotating liquidity, that's automatic, but that's according to what you've ordered. Well, I guess ordered it or asked it to do, how you've established your strategies.
Exactly. Yeah. The execution and
right.
and the rotating liquidity is automatic, but the strategy is manual, right? That's something that the user had to create. The protocol didn't create it for them.
So when we're talking about like the evolving AMM design, it almost sounds more like it's an evolving order book design.
Yeah, I'd say that the thing that the market doesn't like about AMMs is the lack of agency. And so the market really has demanded more, they want more control, right, over what happens to the funds that they're effectively trading. And so, I think it is getting more order book like, because maybe an order book is the epitome of full user agency and nothing assumed on behalf of the protocol. So it's drifting towards an order book in that way, because order books are like 100% manual, whereas AMMs are completely automated.
Okay, so you say order book like. Maybe I'm missing something, and we can clarify that. In what way is carbon not an order book then?
Sure.
You say order book like.
So I think if we wanted to adhere to the most stringent definition of an order book, there are a couple of things that we should acknowledge. One is that when you're placing an order, it's for a specific price, right? And depending on which region of the world you're in and which type of asset you're trading and what type of exchange you're on, there might be a little bit of wiggle room, right? Like maybe the exchange will offer you that price plus or minus like 1 basis point, just because it's difficult to guarantee the exact execution in some exotic assets and things. But things that are pretty liquid, they generally you can choose the price up to whatever the maximum resolution is that exchange offers. But it's still one price, and then you put up the amount of the asset that you're trying to sell. So let's imagine that you've got, I don't know, like 100 1 gram gold coins at home. and you wanted to sell all 100 of these gold coins for, I don't know, what's the price of gold now? So it'd be about $10,000 ish worth of gold. So each one of these coins would be worth about $100. So you would say, fine, okay, I'll put up each one of these. I'm putting up the entire collection of my gold coins for $100 each, meaning that I'm selling the entire set for $10,000. So you can think of an order book a lot like eBay, right? Where you would actually go up and say, okay, I'm selling this set for $10,000. And because there are 100 coins in the set, you could calculate that you're getting them at $100 per coin. But really, you either buy the whole set or you don't. And that's really how an order book, a conventional order book operates. You have to put in the price per thing, but then you also need to nominate how many things you are actually buying or selling. Whereas on something like carbon, we say, well, if you can't accurately, like if you're not confident enough to be able to choose a single price, you can choose a price range, and we'll still give you that square root profile between those two prices that AMMs have kind of become known for. And this is I consider this a feature and not a bug, right? This would be akin to cutting up all of those $100, all 100 of those coins, and selling each one at a different price because you don't know how high the price of gold is going to go. So you could imagine
kind of why I was asking if it's an evolved order book, right? Because it is a feature. Like, I mean, I consider it a feature as well,
Yeah, it's almost like convergent evolution in a way, where AMMs have kind of drifted close to, like, they started completely in a different place to order books, and then have kind of approached order books, I guess because this is the kind of thing that the market wants, right? It's a kind of an elegant proof that order books are, if this order book model in DeFi becomes very successful, it's kind of an elegant proof that this might actually be the most effective and efficient way to run an exchange, or to make markets liquid. But to your point, carbon, it still hangs on to its evolutionary lineage, and that ability to use concentrated liquidity curves to set not just a single price, but a price range. It is, something that a conventional order book doesn't have. And in that sense, I call carbon order book-like, right? Because even though you can, if you wanted to, right, you could use it exactly like an order book. There are things that you can do on carbon that regular order books can't do, such as that square root profile between two different price points. If you wanted to sort of de-lever your position a little bit and hedge. More than that, that capability, or that property that AMMs have, where they can sort of reuse the same liquidity over and over again. This is also something that order books generally don't do. And so, Carbon's rotating liquidity feature, where you can, sell your Bitcoin at some price for whatever, let's say DAI, and then use that DAI to rebuy, WBTC again as it comes down. This is something that, again, normal order books cannot do, because when an order is executed, it's essentially struck from the book. And then someone who's had that order be filled would need to come back to that order book with the funds that have just appeared in their account, and then place a new order to buy something at a new price as its price comes down. So that aspect of Carbon being able to rotate that liquidity and execute that strategy in an ongoing way, or a recurring way, is also decisively not order book-like, and speaks much more to its evolutionary lineage in AMMs. So for these reasons, right, I call Carbon order book-like, because even though, it does have all of it can do all of the things that a conventional order book does, it does extra stuff as well. And because of that extra stuff, I'm not really confident calling it just a straight up order book. And to compare it to an order book, I think is more helpful. But maybe maybe DeFi will invent a new word for these types of products in the future. Maybe we'll just continue to use the term AMM, even though it's not really speaking to those early ideals that we had for AMMs in the beginning. But whatever, I still think order book like is a helpful term to use in the interim, because it disambiguates that sense that it's it's not entirely just an order book that has something extra.
Okay, I understand. So like I call it an advanced order book, but I maybe just order book like. Helios had a question in our chat here. So he says, I think my question in regards to AMMs is not so much will they go away or not, but how will Carbon play with them? For example, are we just all trading with each other trying to outgame the next Bancorian? Or will AMMs or other protocols start to dip into Carbon's liquidity, or Carbon sells to AMMs? That's what I think is important to know or think about. If the masses do not build all the gaps in these bonding curves, does it be worth it for those entering at early stages?
Yeah, it's a really terrific question. So it's really important that that we make sure that the Carbon equations, for example, can be solved versus the Uniswap equations. And this would allow someone, for example, to arbitrage between these two protocols efficiently. But more importantly, I think also to route between these two protocols. So it could be that you want to buy something from Carbon just on one of its orders, but that's because it's an intermediate token that you want to then buy something on Uniswap V3 or SushiSwap or whatever. A good example might be that there's a really cool new trending meme coin or something that's available on Uniswap, and you've got you're trying to buy that token with, I don't know, something like WBTC, but it's only paired with DAI, for example. It could be that routing that WBTC to DAI as an intermediate swap would necessarily be benefited by going through Carbon, because we're expecting, or at least I'm personally expecting, there to be a decent amount of concentrated liquidity for those typical pairs, and that you'd get a better deal doing that than if you had just gone through Uniswap V3 directly, for example. And then that DAI can then be swapped back for the meme token that you're hoping to acquire. So things like that. And it speaks as well, just to sort of in a more general sense, you want to make sure that that liquidity across Ethereum is kind of flowing into and out of and between all of these different liquidity products all the time. So another good example of that is that lending protocols often need to liquidate stuff, and even though this is generally done via a liquidation auction of sorts, it still is done essentially in one block, or at least most of the time it's done in one block. And so you want to make sure that those liquidators can very quickly access the liquidity that they need, and via a concentrated liquidity product like Carbon is going to be is going to be massively advantageous both to them and to the people that are hoping to get their orders filled. So yeah, it's not about I think one of the things he said there was it seemed to be that there might be this like competition or something between different Bancorians to utilize the protocol. I'm hoping that it doesn't end up in that sort of level of cutthroat competition, but there still could be this aspect of competitiveness around the mid-market price, where liquidity is likely to be is going to make that same sort of V shape that it does on conventional order books. But yeah, these things are designed to play well with each other. That we have arbitrage tutorials, I think, coming out, which are highly technical, but obviously you're welcome to read them if just to satisfy your interest. And I think the SDK and some other things will also show how to route between, like Bancor Carbon and Uniswap v3, or Carbon and a standard constant product liquidity pool, and so on. So yeah, there should be enough supporting literature at the time that Carbon goes live, that it will be relatively effortless to process liquidity between all of these different products in a relatively straightforward manner.
This kind of reminds me of our call with Arrakis, actually. We were speaking to how they can use Carbon, and they made it like super clear that they are like DEX agnostic, I guess, and how they can use both simultaneously to do exactly what you're speaking about now, in theory.
So I think one of the things that I've tried to demonstrate recently to a handful of different people is that you can actually use Uniswap v3 and Carbon simultaneously to create this kind of like super advanced strategy. Because if you take any price chart and have a look at it and wonder if you had a time machine or something and you went back a week ago, what's like the best strategy that you could have set up on Uniswap v3 that would have been able to take advantage of that price action during that week. And then you can ask yourself the same question of, okay, what would have been the best strategy I could have set up on Bancor Carbon during that week? And what's interesting is that they're always the opposite, right? So whatever works, like, for any sort of type of price movement, generally where you draw your strategy for Uni v3 is is exactly between where you would draw your strategy for Carbon. And so I actually expect that some of these more sophisticated protocols like these, what are effectively going to be the next generation of yield aggregators, except instead of, just trying to find liquidity mining rewards, they're actually going to be using protocols for their intended purpose. So things like Arrakis v2, I think that they will probably want to create simultaneous positions on Carbon and Uniswap that will benefit from different types of market movements during during a particular price cycle of the two assets that they're providing liquidity with. So yeah, it's a fair observation, Jen.
So kind of going back to what Rick was saying earlier then, in his thought that some might view this as like a competitor to V3. Some are kind of viewing this as a competitor to Uni v3 also, but it sounds almost more like they can be used complementary to really gain the most what each one has to offer in its own right, I guess.
Yeah, I don't think any of these things really realistically compete with each other. Probably the competition between standard constant product liquidity designs and concentrated liquidity designs, so like Uni v3 compared to Uni v2, those kind of are in direct competition with each other in a way. One of them is just the most delevered version of the other. And you would have heard people start to talk about leverage on a concentrated liquidity position at the time that Uniswap v3 was released, and in some of the literature that's been created since then. Whereas for the competition between symmetric and asymmetric liquidity protocols, I'd say that there really isn't any. So it's important to make that distinction. Concentrated liquidity and unconcentrated liquidity or normal liquidity protocols, they are sort of an extension of each other. Just as when you provide liquidity to a Uniswap v2 pool that you fund the full range, you can actually do the same thing on Uniswap v3. So it's kind of in my opinion, that's a very good demonstration that these things at least can be in direct competition with each other. But what you can't do is sort of a buy low, sell high strategy, which is you'll start to hear us using the vernacular of things like fading, right? So that is a fading strategy, or a scaling in, scaling out strategy, which is the price range that you might choose to buy and sell a token within. But rather than choosing a discrete price, you want to choose all the prices in that range. Those types of things, so fading and scaling, are not really things that you can do very well on a typical concentrated liquidity protocol or a constant product liquidity protocol either. So I'd say that Carbon is the most removed from these other designs, whereas standard constant product and concentrated liquidity are close enough together that you could say that they are in competition.
Got it. Thanks so much. Helios had to run, but he thanked you for answering his question, said that you answered it well. So I just wanted to relay that to you. I don't think I have any other questions in regards to, is Carbon an AMM, or, even just comparing it. Last week, there was some content that we put out, or that I put out, and it was, kind of comparing us to limit orders. And so I wanted to touch on that a little bit, and we did. Rick or Glenn, I know you guys are up here, and anybody else that's listening in on the call, if you have any questions or you want to add anything, I want to just kind of give it a minute. Or Mark, if there's a point that you wanted to touch on that I didn't, by all means, please do.
I think maybe the discussion here, I think, is kind of semantic in a way, because we're just talking about what we mean by different words. And I'm not trying to enforce a
narrative.
Yeah, or a particular reading, right, of AMMs and stuff. I'm just kind of offering my perspective on it, because in my view, right, AMMs do have a very specific meaning, and to say that Carbon is an AMM is kind of contradictory. But I'm also, I also concede that the meanings of words change over time, and so it could be that that the industry and its users, the majority of them are convinced that anything with a bonding curve that trades is that's enough to classify it as an AMM. And if that's kind of the definition that everyone lands on, so be it, right? I don't really mind. I'm not trying to push that this is the definition that we should all use. I'm just saying that at this point in time, it is worthwhile discussing these things, because if we lose too much, I think, of the things that made AMMs special, at least in the way that we define them, then they just become a synonym for a decentralized exchange. And I think that is bad, right? I do like having specific words that describe specific things, because it means that the way that we communicate with each other is a little bit more efficient. But I've met other experts in the industry that disagree, and they just think, an AMM is just anything with a bonding curve inside it, or anything with a liquidity pool, where a liquidity pool is just any smart contract with tokens in it, and I think it kind of remains to be seen, right? I think that definitions, in a way, are sort of emerging or emergent properties of culture. And if culturally people start, continue to refer to Carbon as an AMM, then I will, happily adopt this new, less exacting definition of an AMM. I won't take any issue with it. So I just wanted to make sure people understood that, right? This discussion isn't me, saying that this is the definition of an AMM and this is what we should all do. It's just, does the term still apply? And if it does, that, we need to recognize that we're changing the definition a little bit compared to where it started.
Right. And I called it a hybrid. So just to build off of what you were saying, it's like the reason that I wanted to have this discussion wasn't to say it's not, and it wasn't to get you to say that it's not. It was really just to, there are different properties of an AMM, there are different properties of an order book. I was calling it a hybrid. I was calling it this advanced trading protocol and an advanced order book system. And so it was really to just kind of discuss all of the above, and why, depending on your view, and your definition of these things, why they can all be relevant and true.
I think
So-
it's almost like when the Chromebook and similar products started to get released. And this was back in, I don't know, 2010-ish. And I remember back then, like, it was a point of discussion, like, can we even call this a computer? Or, like, can we call this a laptop? Right? And it seems silly now because it's like, of course it's a laptop. But the fact that it didn't have any internal storage was a reason why in the marketing they actually needed to be specific about that this is not, this isn't a laptop like you think it is. And so I think they, we invented words like netbook and other things just to make it clear that, this thing doesn't have internal storage. But, now, a decade on, we can just call it a laptop, and, whether or not it has internal storage just turns out was not, critical to the definition in the first place. And it could be that, the way I feel about AMM is similar. And, a decade from now, we'll look back on this conversation and be like, that was a weird take, and it turns out it's completely irrelevant. And so, yeah, it absolutely, it could go that way.
Cool. Well, thanks so much, Mark, for joining me, and thank you everybody for joining us. I guess we'll just continue kind of breaking it all down a little bit and looking at the different features that it has to offer and deciding on our own kind of what it actually is and how we want to refer to it. But either way, the features are what they are, and it's kind of nice being able to bring the best of both worlds into one product. So with that, thank you again, and thank you to all of the listeners for joining us.
Thank you, Jen.
For sure. Thanks.